Have you ever looked at a giant corporation and wondered how they handle their biggest investments? I'm talking about massive factories, critical software, things that last for decades. Well, today, we're going to follow the entire life story of those investments, what accountants call long-lived assets, right from the moment they're bought to the day they're finally taken off the books. So let's start with a big question. Imagine a company sinks $1 billion into a brand new factory. It's built to last for 30 years. Now, how in the world do they account for that huge cost? Do they just take $1 billion hit to their profits in year one? That seems kind of harsh, right? Or do they spread it out, a little bit at a time over those 30 years? This one decision is huge, and it's exactly what we're going to unpack. All right, so in the world of accounting, that factory is called a long-lived asset. It's a fancy term for something really simple. Any resource that's expected to help the company make money for more than 1 year. And these come in two main flavors. You've got your tangible assets, the physical stuff you can actually touch, like buildings, machines, vehicles. And then you have the intangible assets, the valuable stuff you can't touch, like software patents or a famous brand name. Now, to make all this super easy to understand, let's use a simple analogy we can all relate to: owning a car. We're going to follow its entire life. The day you buy it, the years of driving it and watching it get older, that unexpected fender bender, and finally, the day you sell it. This journey? It's exactly what companies go through with their biggest, most expensive assets. Okay, let's dive into the first chapter of our assets story. This is the very first fork in the road, the first huge decision a company has to make. Should we capitalize this cost, or should we expense it? This choice happens right at the beginning, but believe me, its effects are felt for years to come. So here's the fundamental question it all boils down to. When a company spends a chunk of money, is that an immediate cost that hurts your profits right now, or is it a long-term investment that's going to pay off over many, many years? The answer completely changes the financial story. Let's break down these two paths. If you expense a cost, bam! It hits your income statement right away and lowers your profit for the year. It's treated like a regular day-to-day operating cost. But if you capitalize it, it's a whole different story. The cost becomes an asset on your balance sheet. The cash you spent is listed as an investing activity, not an operating one. And that cost, it gets spread out as a small expense over many years. Same amount of money spent, two totally different financial pictures. Let's look at a real-world example from a company called Trofroni SA. They bought a new machine. Now, look at what gets capitalized, what becomes part of the asset's cost. You've got the purchase price, of course, but also delivery, installation, even reinforcing the factory floor. Why? Because all those costs were necessary to get the machine ready for its intended use. But look at what's expensed: staff training and a general factory paint job. Those are just considered routine operating costs, not part of getting that one specific machine up and running. And let me tell you, this isn't just some boring academic rule. This choice can be used to commit massive fraud. The poster child for this is the infamous WorldCom scandal. They took over $3 billion in regular, everyday operating costs, stuff that absolutely should have been expensed, and they illegally capitalized them. What did that do? It made their profits look way higher than they were, and it totally hid the fact that the company was in a complete nosedive. Okay, so the asset is officially on the books. We've made the big decision to capitalize it. Now we enter its long, productive life. For the next 10, 20, maybe 30 years, this thing is working hard, generating value. But it's also slowly wearing out, and our accounting has to reflect that reality. This process has a name you've probably heard before: depreciation. All it is a systematic way of taking the total cost of an asset and spreading it out as an expense over its useful life. Going back to our car analogy, this is the slow, predictable loss of value you get just from putting miles on the odometer and from general wear and tear. Depreciation is just how accountants recognize that slow, steady decline. So we know we have to spread the cost out over time, but how? I mean, should the company take the same amount of expense every single year, nice and even? Or does it make more sense to take a bigger hit in the early years when the asset is brand new and most productive, and then less and less as it gets older? Well, there are two main schools of thought here. First, you've got straight-line depreciation, which our hypothetical evenly co-uses. It's the simplest. The expense is the exact same every single year. Super stable, super predictable. On the other hand, you have accelerated depreciation, used by Sooner Inc. This method front-loads the expense, meaning you recognize higher costs and therefore lower profits in the early years. So why would anyone do that? Well, a big reason is that lower profit means a lower tax bill upfront.
And the impact in year one is pretty shocking. Just look at this. Sooner Inc., using that accelerated method, has a depreciation expense that is more than double what Evenly Co. has. And remember, it's the exact same machine, bought for the exact same price. The only difference is an accounting choice.
So what does that higher expense do? Well, it flows directly down to the bottom line. Sooner Inc. ends up reporting a lower operating profit. Now, it's so important to remember that their actual business, the cash they're bringing in from sales, it's identical to Evenly's. The entire difference you see in their reported profit comes down to that one little accounting choice.
So, why should you, as an investor, care about this? Well, think about it. Sooner Inc. is going to report lower profits now, but as that big early depreciation expense starts to shrink, their profit growth is going to look amazing in a few years. Evenly, on the other hand, will just show this steady, predictable growth. The method they choose fundamentally changes the story their financial statements tell about their performance over time.
Of course, life isn't always a smooth, predictable line, and neither is the value of an asset. Now we get to the fun part, the unexpected plot twists. We're talking about impairment and revaluation, which are how we deal with sudden, dramatic changes in an asset's value. So, sometimes an asset's value just craters unexpectedly. In accounting, we call this an impairment. Let's go back to our car. Depreciation is the slow loss of value from normal driving. An impairment is like getting into a massive car wreck. The value of your car plummets overnight. Companies have to recognize that huge loss on their income statement right away.
And this is where we see a huge split in the accounting world. You have the international rules called IFRS and the US rules called US GAAP. Under IFRS, if that wrecked car somehow gets repaired and its value recovers, the company can actually reverse the impairment loss and write the value back up. But under US GAAP, the rules are much stricter. Once you write an asset's value down, it stays down. There are absolutely no takebacks.
The plot thickens even more under IFRS. They allow something called the revaluation model. This lets a company periodically mark its assets up to their current market value, not just down. So imagine your factory is suddenly in the middle of a red-hot real estate market. Under IFRS, you can actually increase its value on your balance sheet to reflect that. This is something that's totally forbidden for most assets under US GAAP. Okay, our asset has lived a long, productive life. It's been used, it's been depreciated, it might have even had an impairment. But now it's time for the final chapter, derecognition. That's the fancy word for taking it off the company's books for good. So how do you handle selling or getting rid of an asset? The calculation is actually really straightforward. Step 1, figure out how much cash you got from the sale. Step 2, find the asset's current book value on your balance sheet. That's just its original cost minus all the depreciation you've taken over the years. And step 3, the difference between those two numbers is your gain or your loss on the sale. Simple as that. Here's a perfect quick example. A company called Musalauka Diners sold some old pizza ovens. On their books, the ovens had a value of $1.9 million, but they managed to sell them for $3.1 million in cash. The difference, a cool $1.2 million, gets recorded as a gain right on their income statement. So let's wrap up this whole journey. What are the big takeaways? First, that initial choice, capitalize versus expense, it shapes a company's financial story right from day one. Second, the depreciation method doesn't change the total cost, but it absolutely changes the timing of when profits are reported. Third, impairment is how we deal with those sudden, unexpected drops in value. And finally, remember that accounting rules are not the same everywhere. The differences between IFRS and US GAAP can lead to very different results. And that brings us to one last really important question for you to think about. Now that you know the rules, what does a company's depreciation policy really tell you? When you see a company using an aggressive, accelerated method, what does that signal about how its management sees the future? Are they just trying to lower their tax bill in the short term? Or is it a sign of incredible confidence that they expect profits to grow so fast in the future that they can easily absorb these big expenses now? You see, the choices a company makes in its accounting, they often tell a story that goes way beyond just the numbers on a page.